say make money, money, make money, money, money.
Make money, money, make money, money, money. Money makes the world go
Welcome in to the Stock Jocks, Just the Tips, episode number 3. I'm here with my co-hosts, Bruce and Gordon. How are you guys doing?
Doing great. George, I just had one quick question before we start.
Yes.
Did you do your hair for us? Or do you do this just every day, no matter what?
I wake up looking like this, my friend.
It looks very Gordon Gecko. I think he's trying to channel me.
Trying to channel us. That would be straight slick back. No, look at these clothes. This is Easter Sunday. Like we celebrate over here. We're God-fearing folks. We went to church and you got to dress up for the Easter bunny.
Yeah. Wow. So you're a
Looks great, man.
You and your wives are furries. I heard that. Word on the circuit in the valley.
What did you guys do for Easter? Did you do anything with the kids?
I went to a beach. I ate a big cocktail of shrimp. And yeah, it was wonderful. I enjoyed the strong dollar, the strong relative dollar to the peso. It was fun.
Did Easter in Naples with the in-laws, which was a lot of fun. We had a Easter bunny come down on a chopper yesterday.
Jeez, this is how the rich people celebrate.
Okay, so
we flew to Naples, and then the Easter bunny dropped in.
I paid $20,000 to put down my dog, and it didn't die.
It did feel like a scene out of Mar-a-Lago. I'm not gonna lie, but
Naples, Florida, right? Not Naples, Italy. You get the chopper.
Naples, Florida. Yeah, Naples, Florida this time. But it was a lot of fun. The kids go crazy, so it was fun. No better way to celebrate the resurrection of Jesus Christ than to stuff your face full of sugar and candy.
Yeah. No better way to spoil your kids than drop Easter bunnies from the sky on them.
Speaking of Florida, I bet you Tootsie's probably in Miami would be a great place to wake up on a Sunday morning. At least that's what I've heard on the street. Anyway,
well, bunnies are the theme there. No matter if it's Easter or not, bunnies are usually the theme of that place.
Yeah, that's right. Yeah, sometimes they're wearing, I was going to say, like neon thongs. All right, we should do the disclaimer, right? I added some words to this that I thought would clarify it. None of this buffoonery should be considered investment advice because it is ultimately buffoonery. Equities, options, and other financial instruments involve risk of loss of principal in personal relationships, including wives and sugar babies. Consult a financial advisor. If you invest in this based on this conversation, you're an idiot and you deserve whatever returns that I, Gordon, get, and that will probably be negative. So with that, again, the topic is DigitalOcean. But there's any topics you guys want to hit this week before we jump?
All right, let me try the news drop. All right, here we go.
I gotta say, I feel like I had higher energy. It had higher big dick energy than yours did. I really like that you put your heart into that one, though.
A for effort. A for effort.
Like the Vienna Voice Choir.
No.
So
I was in the choir in high school, to be clear, and it was not a pleasant experience. But I got to go to Disneyland.
Was it the choir or the Glee Club?
It was the choir. It was the choir. I'm a bass, in case you were wondering. Whoa, see?
Not what I heard.
So anyway,
I equate bass with manliness. For me, it's not a stretch.
You guys need to head over to Tootsie's, I think, get some of this BDE out. So anyway, let's go back to, I think the big topic is IPO window. And basically, I think the big question for a lot of folks is, okay, Reddit priced, did well. I don't know how much it finished up, but in theory, I guess True Social was not exactly an IPO, but there was a pricing event there. But there's an AI IPO recently too.
Astera Labs.
Thank you. So I put it to you two. Is the IPO window open? Should we start pulling our IPO umbrellas out?
So the two IPOs that I think drew a lot of attention over the past week were Reddit and Astera Labs, and both are probably on opposite ends of the spectrum. Reddit is a social network community of news and other things that people like to comment on. It's basically a really robust, souped-up, user-generated forum. And Astera Labs is a fabless semi-company that provides connectivity solutions, mostly between AI accelerators, the network, and compute. And I would say they both priced at the top of their range and had pretty solid sort of public receptions in the first week. It'll be interesting to see, I think, where the stocks settle out. These are probably two of the most notable IPOs that have come out in the market in the last maybe 6 to 12 months. And a lot of people will think that these two companies or maybe these two first IPOs are a good barometer for where appetite is in the broader market for initial offerings. I would say that there was enough pent up demand that it really drove both of the stocks up significantly past, I think, their IPO valuations. And a lot of people always ask the question of whether the companies left money on the table by pricing so low and having such a big kind of first day or first week pop. We'll see where the dust ultimately settles. It does feel to me, as I look at Astera Labs, that it's really overvalued in this market in some ways. So they came out with a $5.5 billion valuation at their IPO. They did 116 million in revenue last year, and let's assume that they grow to like 160 million this year, so like 40% growth. They grew 45% last year. That's basically like a 35 times NTM revenue multiple. The stock has almost doubled. It's basically trading at $8 to $9 billion. So they're trading at, call it 56 to 70 times next 12 months revenue, which is very aggressive. And I think they're principally beneficiaries of all the flight to AI, whether it's quality or not quality. And they obviously came out on the back of a lot of strength in that industry, and people are looking for ways to play it, I think, in both institutional and the retail market. So they've been big beneficiaries. We'll see what happens, though, over the next 6 months before lockup comes. And then I would say on Reddit side, they actually priced a pretty middle of the fairway type IPO. It was a $6.5 billion IPO at, call it, 7 times next 12 months revenue, assuming that they grow another 20% in 2024. They grew 20% in 2023. So that gets them to about $1 billion in revenue or $1 billion in ARR. It's trading up since then. So it's trading at about $8 billion, which applies about 8 times next 12 months revenue, which for a company that's growing at 15 to 20%, I don't think is outside of kind of the realm of what we should or could expect. I think there's going to be a lot of scrutiny, though, in terms of user engagement, user numbers, where their ARPU is per user, how their pricing is impacting. And they'll get compared against, I think, some very strong companies in Facebook and Snapchat and the private markets, TikTok. And so I think it's one of those companies where there's a lot of pre-existing data points. And if they're not able to perform against those data points, I think the market's going to be fairly punitive, even over the short term.
Hey, I've got a quick game for us to play. I know we're not used to this, but just humor me here a second. I'm going to give you the name of 2 websites, and you tell me which one has more visitors. Amazon or Reddit?
Amazon.
Wah. Reddit gets more traffic.
Unique users, or is that more traffic?
It's not unique visitors. Facebook or Reddit?
That'd be interesting. They probably don't know. It's basically the glory hole of the internet, so they have no idea how many unique visitors they probably have. The other thing is, just, what's the play here on AI, really? It's just they can scrape people's data. They basically, I think I've read some stories about them selling user data. Is that really an AI play? It just doesn't feel like it is to me. Everything's an AI play ultimately. It's also a cesspool with all kinds of, it feels like regulatory risk, and I don't know. It just got an icky flavor to it to me. I don't know. Maybe that's just me because I've got a guilty conscience. I don't really see how this is an AI play.
I think the cesspool.
The glory hole of the internet. That's my new name for Reddit. I trademark that shit.
I think the cesspool is actually 4chan, where they've kicked all of the Reddit like degenerates off their platform and into 4chan. I think that's where most of the heavy lifting gets done on the cesspool side.
It's like the sieve. We can end it there. I just kind of feel like, yeah, let's screen share some Reddit. I can show you some fun places / Mexican swingers. Hey, anyway.
I'm definitely much more intrigued. I do think the IPO window is now open. I think you're going to see more companies trying to take advantage of the success that we've seen from these 2 names. I do think that Reddit is definitely the much more interesting of the 2. So it is I didn't get to finish my quiz. You guys didn't really play along, but it is the third most traffic site in the world. So it's behind Google and YouTube, but above many other names that you would have thought.
That's the number 3 sex trafficking site, I think. Maybe, I don't know.
Well, it's
I
above
shouldn't
all
be
your
sure
favorite
Reddit,
sites. I
but,
did
like,
see Pornhub on the list, and it was way down. It's definitely more popular than that. But what I like
I just want
about
to play
them
the
is
OnlyFans IPO.
the debate for me is, if you look at them, they way under monetize versus Facebook, but everybody does. So if you look on a per user basis, like, they're monetizing nowhere near Facebook, and they don't know as much about you as Facebook does, right? Facebook is the most targeted ad platform that exists or has ever existed. The amount of information they know on you allows them just to extract top dollar. The opposite end of that spectrum would be something like Twitter, or now called X, right? Which knows very little about you. Most people consume news on it. Used to be a lot of brand advertising before Elon insulted everybody that, advertised on there or would want to advertise on there. But they do know Reddit sits somewhere in the middle of that. And so the opportunity set is, it'll never be a Facebook, but they probably under monetize on a per user basis based on the amount of information they have for you. And so if they can actually capitalize on, that's the huge opportunity set for these guys. That being said, they've been at this for 19 years and they've never monetized on it.
I think the issue for Reddit versus Facebook or versus Snapchat, for example, is that a lot of the users on the platform are anonymous, and that's the power of the platform. And the two things about Facebook that I think are interesting that I've heard anecdotally are, one, everybody goes to Facebook to look at pictures, or properties of Facebook to look at pictures. Guys go to Facebook to check out girls, and girls go to Facebook to check out girls. That's the reason everybody goes to those platforms, and they're so powerful. The other piece is, I've heard that pictures on Facebook is a more viral feature than every single other feature Facebook has ever come out with combined. And so basically it's a picture platform, and Reddit doesn't have that kind of similar appeal. I think, like, Snapchat is also basically a video slash picture social graph. I think like they're somewhat capped in terms of the amount of revenue they'll be able to drive from users, just given the like anonymity as well as how the platform is structured.
Yeah, no, I don't disagree. I think that's the challenge that they have. They do know certain threads at your end. For example, I'm in a tech networking thread on Reddit. That was the last one I think I commented on. Not that I'm on there very often. So unlike our friend Gordon over here, I'm actually on there for educational purposes. But yeah, I agree with you. I think
I'm
it is
getting
a harder
education
audience to
very
monetize.
Yeah, this reminds me. I did an interview of a not to be named small or a mutual fund in Los Angeles, and I actually compared notes with other people interviewed there at one time or another as analysts, budding young analysts, and they're not shy or unconfident people over there. But they had a interview question about two factories exactly the same across the river from one another, and one was had an ROE of 30, and the other had an ROE of 5. And basically, the premise of the problem was that a contrarian is going to want to buy the company that is not doing things right because they're going to figure out what the other one is doing. And so I think that's the basic thesis you're making there. I've seen that argument made before. I think the quality of user, which is actually saying a lot, but quality of user at Reddit is probably not near what it is at Facebook. And I mean, maybe it's probably a lot closer to Twitter, but I would argue probably even worse than Twitter now. Even who knows that with all the bots, hard to say. But okay, point taken though. There's potential to monetize all these pictures people are sending to each other on Reddit, in forums or what have you. I'm sure, our dear listeners. Okay, IPO window still feels like it's only a crack open. Just to close this topic a little bit, it's encouraging to see a couple come out. It shows there's some demand that will only beget a higher likelihood that others will try to get out. Just being encouraged by that. Talking to a banker I know in the Valley, he was saying it feels like a next year event still, like they're all up in the tarmac, but it's going to be only either well-known or desperate folks trying to get out in this weather still. But obviously stay tuned. That can change pretty fast, but it is encouraging to see a couple get out, especially for our friends that work on the sell side. Any other thoughts on this topic?
As long as you have AI in your story, you're fine.
There you go. It's worth 5 turns, 10 turns in the multiple. And you don't have to make any money. You can use West Coast multiples like Bruce likes.
FOMO.
That's right. Yeah, I know. I just hate everybody else's money. So anyway, that's a good segue. Let's just move on to our friends at DigitalOcean. And so there was some internal debate here at Just the Tips on the topic committee about whether anybody wanted to hear about. I'm not sure what words exactly were used. It was the size was discussed by this team.
It's not the size.
I
It's the
personally am a
motion of the
lover of
ocean.
small cap. Yeah, it's like the small cap premium, right? Like I don't think. No, I mean, setting aside Bruce's family money, like most of us, we're not making investments that big that we're moving the markets. Like I can.
We're not dropping Easter bunnies out of helicopters.
No, we're not.
To the chopper.
And I like to think that we could say something new. I remember like somebody telling me a story about how like the head of UT's money management program, like somebody show up talking about Microsoft, he'd scream them out of the room. And we're not pitching Microsoft here, but we're getting close with some of these names, tens of billions of dollars. So anyway, it's partially my fault that we're covering this. Basically, like this is a passion of mine that, candidly, I got to disclose. I own this thing, but not that long ago. We'll see how it hasn't played out for me yet. All right, so let's
How
go
much
back
do
to
you own?
hundreds of dollars. Let's see here.
Hundreds upon hundreds.
No,
I
it's
will
like,
also point out that once upon a time, super duper micro was a small cap. So now it's
it was
firmly
one of
in
those
the
companies.
mid cap.
Let's remind
Yeah,
everyone.
It's part of the
Yeah, isn't
S&P
it?
500.
yeah. Now it is.
Yeah, they're a real company. More reasons why you should not listen to Gordon. All right, let's jump to DigitalOcean. All right, so most people, I think, in the audience probably haven't heard of DigitalOcean. Fast facts. All right, it's just really short version. I think you could say it's the AWS for developers and small to medium-sized businesses. So they're a compute-focused company. You can get a server for $4 a month from these guys, or at least at one point you could. And so for a long time, they just catered to a lot of tinkerers, people that wanted to put a web page up or start a small business and needed a web presence or a web server. These guys were the go-to, and they're classic, like under basically a subset of features to an underserved market, the SMB in this case. So they went public in March 21 for $47. Last I looked, they had a 38, technically a broken IPO, but you know what? Like a lot of broken IPOs from that IPO class. So don't feel bad, DigitalOcean investors and employees and friends. So competitors, obviously the big guys, Amazon, Microsoft, Alphabet, through their public cloud offerings. There's a French company called OVH you may have heard of, but they're also a small cap player like DigitalOcean in this space. Cloudflare increasingly is getting everybody's business. They sell storage, and because DigitalOcean, as we'll see, they're getting pretty supermarket-y. Like they are competing with Cloudflare. They're a usage-based billing model. So this is not a huge company, as we discussed. They're only $3.5 billion in market cap. Probably not worth Bruce's time. Be as a hobby, maybe in his kid's PA, a starter stock. But they were doing $700 million last year, growing 20%. They've seen a deceleration. We'll talk about why in a second. And last year was also a slowdown year. You can see it in their op margin, but they've been a pretty profitable company, surprisingly, for a small cap company. But they have earnings. I know these are things that Bruce hates, things that have like cash flow and earnings. I know these are foreign metrics, but we're talking about. So they give this evolution from their last presentation. Like they originally were just like, hey, small, scalable virtual machines for tinkerers. Then they became more of a cloud infrastructure company. Like they added stuff like load balancers and storage and firewalls. And then they added other stuff later like Kubernetes. So they tried to become like somewhat of a mini AWS. Obviously, AWS has many hundreds of services, but they are clearly not just one thing. They're trying to do a lot of things at once. And they talk about their differentiation, complex systems. Like AWS is famous. You have this dashboard of shit that is insane. It's very hard to manage. Tremendous overhead and very untransparent pricing. And the big cloud vendors don't support the little guys, blah, 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 blah. Anyway, so this is all that they offer. Like this came from the analyst day back in 2022. They just added tons to their menu for the little guys.
Maybe you can describe like some of those for our non-visual audience.
One thing I'll note, like in 2017, they added block storage, and that's like a whole new, different thing from compute. You know, they're again founded in 2011. Kubernetes services, like these are like virtual machines. Just to really oversimplify it, these are containers, right? So this is an even more mobile computer that's virtualized containerized, right? So it's very mobile. You can spin them up and spin them down. So in the cloud, when you want to deploy resources in a variable way and in a fluid way, like that's a major important software orchestration platform. You guys want to correct any of that? Any other thoughts on
No,
this?
I was just going to add that this is similar to an AWS or an Azure or a GCP, a Google Cloud. It's effectively a general purpose cloud platform that continues to innovate and add new products to get customers locked in. There's a big conference every year for Amazon in Las Vegas called the reInvent Conference, where they basically introduce a number of new features and new products. Every cloud has effectively followed that playbook, not with the conference so much, but more just introducing new features, new functionality, ways to increase the average revenue per user, and ways to increase lock-in for those users on their cloud so that they don't shift to other clouds, and they make it easier for them to use their current portfolio of products.
Yeah, I think the negative thesis on these would always partially be like the graduation, right? This is the starter platform, and if you don't have enough to keep them, eventually they'll graduate to one of the big three higher featured platforms, or maybe now Oracle. We'll see, as discussed in our last episode. So anyway,
Just one quick question. I think the issue with a lot of the clouds is that for several of these kind of core offerings, they become sort of commodity over time, right? Like offering load balancing, for example, or different forms of CDN or managing Kubernetes. These are all effectively commodities for most of these cloud providers. How does DigitalOcean prevent their platform from being commoditized in the same way? What is the kind of factor that allows them to lock in their customers better than other clouds would? Or why wouldn't I just go to Amazon instead of using
I think it's
DigitalOcean?
like the inverse pitch. First of all, like they have way cheaper egress, and related to that, like we talked about this Cloudflare, but there's a number of players, including Oracle's in this alliance and Google. That is, hey, Amazon, it's free to upload data, but it's 9 cents a gig to get it out. It's tremendously expensive. You can store the data for 6 months for the price that it costs to get it out. I think it's actually more than that in some cases. So basically, there's a major tax. They want to lock you in so that you use all the services. And so I think DigitalOcean, they were part of the Cloudflare alliance. Like they're basically saying, hey, customers, like we don't lock you in and screw you over. You'll be free to use whatever wonderful tools that are not offered by Amazon and Microsoft. And by the way, there's a lot of those, right? In AI and other areas, obviously ChatGPT and OpenAI, that's kind of part of the Death Star that is Microsoft's broader orbit. But there's just a lot of tools out there, and I think they can make the pitch that, hey, we're never going to lock you in, and you don't really need most of these features, and we won't give you like bill shock. We won't, because like I said before, they've got their whole company is designed just to figuring out and predicting your bill with Amazon or the big three. And so the simplicity is a major benefit. And so contrary to intuition, like the idea that they don't have enough features, like the more features you have, the more cost you have, and the more complexity there is, and the more difficult it is to manage and all those things. So I think it's a fine line. And certainly like with Amazon, I don't think they can claim to have the best of breed for a lot of services. Like CloudFront is not, I think, considered a good rival to Cloudflare, really. So at the end of the day, I don't know that they have to have all the best features that Amazon has at the same level of quality to retain their customers. It's just a different proposition. They're also a lot cheaper. I think on the compute side, I've seen something like just on like the compute, like I don't know, 25, 30% cheaper, but it's not just the fact that it's cheaper per se. It's just way simpler. There's a ton of community education too, by the way. So they have a huge community, and they've sort of like F5 or some of these other companies that have cultivated a big following of folks that share with one another. They've also just put a lot of investment into their content library. So it's all those things. It's super developer friendly. Nobody in Amazon is going to give you a call back to walk you through how to build an app on Amazon. But you can go to a library with these guys and get a sympathetic ear, perhaps, at least amongst the community, and you won't get confused as quickly, blah, blah, blah. And it'll be cheaper. Does that all make sense?
Yeah, so my understanding is it's cheap, it's simple, and it's going to appeal to those more basic, smaller developers as opposed to the big shops, and that's the value prop,
Right.
if I had to summarize.
Yeah, I think that's fair.
That type of customer base would get you a premium or a discount to where the market trades?
See, this is a debate we can get into, right? I think there's the conventional wisdom is that SMBs are somehow like a lower quality, right? They're more affected by macroeconomic swings. Like they can graduate on you, right? They're harder to serve because they're just smaller, more expensive to serve. Part of the beauty of it is like with the low friction self-serve model, they're turning that on its head to a certain extent just because you can use content to acquire customers cheaply. Certainly through the cycle the last couple of years, like it's been pretty impressive to see like Azure growing like close to 30%. Amazon slowed quite a bit, and those companies have just been really durable. And we're just talking about Oracle's crushing it. There's an AI piece of that too, but these guys are growing a pitiful 11%. So certainly this last cycle is, and maybe it's all AI driven, is suggesting there should be a discount. You're welcome, Bruce, for giving you some more ammo in advance. Here's the chart though, just to see how this set up. And just like Cloudflare and others, like they came out, I said 47, I think, and they got all the way to 125 and got down to 20 late last year, October of last year, and now they're back around 40s. So we're catching them, they'd be like in this range bound 20 to 40 range here for a couple of years. Not beautiful. Here's why. So they were growing like 37, 36% as late as December 22. Huge deceleration. Again, usage-based billing, they're talking about contraction. It's not fun, but people are kind of modeling that's going to be about a 10% growth on the top line for now. So here's a quick anatomy of a bed shitting.
Just to go back to that previous slide, though, for a second,
Yeah.
and just looking at your estimates of the folks that can't see it, basically it's going from 37, 36, 20, high 20s to 11 and 10% over the last kind of 3 or 4 quarters. And then it flatlines in the 11 to 12% range indefinitely through December of 25.
Yeah, the trajectory of the last 4 quarters is pretty amazing. 36, 30, 27, 16, 11. It's been straight down. I think there's reason.
I guess my question is,
yeah.
Why do you think this flatlines? Why doesn't it go even lower? And it doesn't seem like even in your forecast that it's going to.
This is not my forecast. This is street. Okay, go put that shit on me. I'm just telling you what the street estimates are. So that's all it is. And this is partially what they've guided you for this year, right? And I'll give you some components of this to help you figure out whether or not this is believable. I want to believe that it is. Like I own the stock. I'm a believer. Like you have to believe this is. I don't know if the stock's really. I think the stock is pricing in this scenario. Like it needs to do better than this, I think, and reaccelerate. By the way, not a lot of reacceleration stories in tech, but it's a weird time we live in. So this is what happened. Like when this first started falling apart. So the left column is like how much did they make or miss reported revenue for a given quarter, and then how much was the revenue guidance off for the coming quarter. And so it all started. The wheels started falling off in June of 23. Did fine on the quarter. Nobody misses the quarter, right? That 0% in June of 23, but that missed revenue guidance.
Just to clarify, that left-hand column is from expectation. That's not total growth. So that's
from street.
Yeah. So they were exactly. If 0% means you're exactly at expectation. If you're 1% means you beat by 1%. Correct.
Exactly. And so, actually, I guess where it really started to fall apart, I guess I should go back to March of 22. I think any decent company, any software company shouldn't be missing reported revenue. If you can't guide one quarter out in software, you should lose your man card or whatever. So usually kick you out of the software space. So then revenue guidance, though, that's where they usually disappoint. And the first one was when they were in the habit of, in that IPO, of guiding up modestly. First came out of the gate, they guided up 2%, and they guided up 3%, and then 1%, and then 0%. The beats got smaller, and then suddenly they guided down a little bit, and boom, re-rating. They were down 18% after they guided down 1%. Just like severe, you would think, after you kind of could have seen that coming. I'm sure there were other components of that, but also, back in June of 23, now I guess a year ago almost, not quite, they guided down again to minus 4%, and they were up by 25%. So I get to see here some pretty big moves at 2 big times. This marked pretty significant decelerations, I think. If we go back and look at the chart, they ended up growing in June of 23. Like you can see that, right? Like that from 27 to 16%. Like that was a more than 10 point sequential decline or I should say a decline in the year-over-year growth rate from one quarter to the next. So massive deceleration, and that only portended more. So Anyway,
It does seem usage based, right? If you have a subscription model, right, like a Cloudflare, like it's very predictable.
yeah,
You know what you're getting because
that's
paying a
exactly,
subscription.
yes. Yeah. It's really, by the way, yeah, you really could get to a debate about what they're calling ARR. R. What's the pirate's favorite SaaS metric? Sorry, I have young kids. I'm here all week.
Dad joke
So
alert,
it's
yeah.
R. Yeah, sorry. Yeah. It's anyway, I kill myself. They like whether or not it's recurring, like somehow the SEC and FINRA they don't seem to mind consumption-based revenue being defined as recurring. It tends to recur historically, even though it's actually like could shut off at any time. It's not contractual. Pretty much, it's utility-based. So I think a lot of investors might not really appreciate that a lot of these quote SaaS companies are not really subscriptions at all. That's one of the S's. So something to think about. Deep thoughts. So
One question: what do you
yeah.
think though stops the decel? Right? Is it the market's probably not going to change? Is it a better execution? Is it a better management team? Is it
I think
more features? What's going to stop the decel here? It looks like they're falling off a cliff.
I'm going to do something really obnoxious that management teams used to do that when I would ask multi-part questions, and I would say yes. They'd say yes. The answer is yes, Bruce. Yes to all of the above, and you'll see why. Just give me a chance. You'll see. So anyway, but I think the short answer, really high level, they have had a big management change. I think they're playing a little bit of catch up. You're banking on there's just a tremendous penetration story still here, and that they can cross the chasm, become that many companies kind of like I guess high level. I think that they can just get a credible foothold in AI and enterprise enough to get this company sold 2x, 3x higher. New CEO makes a bunch of money. Like this gets integrated into some other player, say Oracle. I don't know. Oracle loves to put companies out of their misery at premiums. So I think that's one way. But anyway, we'll get there very shortly. So I'm introducing the new automated FactSet powered Just the Tips podcast comp table. Let's use the simpler one just for now, just to make it like we keep going back to like price to earnings to growth. And then EV to sales to growth is actually even more common. So we can kind of look at this different ways. One way to look at it, just high level EV to sales, like I put a bunch of folks in there. Most of these people are growing faster. So DigitalOcean's forecast to grow 11% in 2025. Everybody else is growing 19. It's not like a crazy, it makes sense they should be at a discount. If you look at like EV to sales to growth, 0.6, or Flin's Cloudflare 0.9. So they're more expensive for sure, but they're like the gold chip as we discussed in their space. But it's not a screamingly cheap company trading at 7 times EV to 2025 sales, enterprise value to sales. And certainly there are more expensive companies. It's a smaller cap company. Their success is not a given. Poor Twilio, is that right? 2 times EV to sales. Not the darling they used to be, but like Datadog at 20 times and Mongo at 15 times. Those guys are growing about double the rate. So it's hard to make. It's not super easy to make a valuation big argument. It's kind of trading at half the multiple because it's growing at half the rate. Sorry, go ahead,
Not
Brucey
to,
boy.
not to foreshadow too much, but I would say that they're actually trading on a free cash flow basis, which you don't show here, a little bit lower than like where the SaaS average would trade, and I can show that in a little bit. But I guess the punchline from my perspective is you get what you pay for here. Stock's decelerating across the board, so of course it's trading cheaper. But
Yeah,
maybe
it's
there's a
not
long-term
fun.
flip at the end.
It's a falling knife. There's a couple things I'll point out real quick. We got a new CEO. We'll get to him in a minute, but he has basically high level. Like this is from his script. He didn't have a slide, so I'm a little bit critical. But there's a lot of talk in here about focusing on like their product platforms. So like here's his background. They got a new CEO. And that's always not a great sign. Okay, basically, I don't know the circumstances of the departure of the last CEO. I thought he was a smart sounding guy. I mean, he has a banking background like some of us, but they replaced him with this guy. He seems very product focused, like he's a nerd, which may be a good thing for a company that needs to retool their product set. This guy was at LogMeIn. He was CEO, and he was before that Chief Product Technology Officer. He was GM at Data Machine Learning for Alexa at Amazon. That was only a year stint during the pandemic. Very stressful time.
I will say, for what it's worth, Log Me In was not a big success story either. The time frame he was there running product, like they got their rear end kicked by Zoom and others in the video conferencing space to the point where basically it was a falling knife that sold to PE and they got out of Dodge. Or did they sell to Citrix? I can't remember now, but basically, yeah, it disappeared off the map. The product wasn't there. It was a poor product experience. If he was overseeing that, that doesn't give me a lot of confidence in being able to step in here as a turnaround artist. And he's got no background proving that he is either. So, like, why this guy turns this company around, I'm not sure.
I think the other piece too is, Log Me In is a much different type of company than DigitalOcean. Like in my
100%.
mind, if you want to turn DigitalOcean around, you don't get the guy who finished in 4th place in the next generation collaboration space. Like you get the guy who was number 2 at Amazon or number 2 at Azure and actually has a playbook for building a cloud. It just feels like the recipe here is set up for disaster in terms of catching a falling knife with maybe a guy who still has to prove himself at the head in the lead role at any company, let alone a company that's on its back foot.
So there are some challenges there. Like ideally, I think you would have seen, Bruce was saying, like someone come in from AWS or Google Cloud that was an executive there to come run this thing. That would give me a lot more confidence than the guy who ran a application in the collaboration space.
I disagree. I would argue the guy from AWS is just coasting on, unless he was there in the first 10 years, like, and built it, like, the name on the business card is not going to be that valuable, right? I think a product person is the right person. Like, you're going to have to get the right feature set. And those people pretty much, they make good. It's like saying I want to get a good person from Wanscaler at Cisco to fucking build a competitor with River or whatever River it was. Like, you would never get the best person, the scrappiest genius. I guess they pay up for the right talent sometimes, but they often have to buy companies to get the right technologies. Is anybody saying that CloudFront's the best technology? Right? Like, why would you want the CloudFront guy? I want the Cloudflare guy. So I'm going to argue that no, I don't want those big business card people. I don't know if this is the right person. I just don't agree that I want the Amazon guy. Half the time, these large company people, you can't tell if they actually did anything, right?
Sure. It is hard from the outside to assess the quality of management.
And it just feels, unless you have someone really strong in this position, like building a product in a commodity market that's heavily competed for with folks that have 10 to 100 times as much capital on their balance sheets than you is a really hard place to play and execute well.
There's a couple companies that have done it, I would say, in the memory space. So if you're familiar, there's like a private company called Wasabi. There's a publicly traded company called Backblaze, small cap. This is their exact pitch. They don't do the full stack, but it's, hey, we will bring simplicity, lower pricing. It's straightforward. And I think both of those businesses are doing decently, right? And so they compete with the big boys, but they've carved out a niche where they say, hey, if you're price sensitive, you want simplicity, you want to understand what your costs are going to be, like, come to us. And they've carved out a niche for themselves that so far seems to be holding, but it does make me nervous. It wouldn't be something that I would be jumping up and down to do. And I think you see the trading multiples, at least on Backblaze as a public company, are quite low. I don't think people believe that party lasts, but their last quarter, it was an accelerating quarter in object storage. They were moving and shaking. There is a case there that works for somebody.
Yeah, I think the question that I would think there at least is just what's the sort of asymmetry here on like risk reward for this type of company? What is the real upside case here that they build a long-term, slow-growing cash flow machine that somehow gets to like a reasonable, maybe private equity type outcome that's a small premium of maybe where they're trading today, or maybe it's a small premium of where they're trading tomorrow, which is going to be maybe significantly lower than where they are today if the deceleration continues? Or would you put that marginal dollar to work at a fast growing company that has a chance of getting a real strategic premium in an outcome that's going to be bought by a larger player at a premium because they need the strategic asset? And that's, I think, the difference that you see even between the Astera Labs and the Reddits, right? Where you have a fast growing company at a much, much smaller revenue base that's getting a much, much bigger revenue multiple. And you have a much larger company at a much slower growth rate that's getting a much lower multiple. And so I think it's just a question of, are you going to lean in on a company that's growing quickly, that has a ton of potential and promise, or are you going to try to win and kind of nickel and dime, I would say, your way to some sort of marginal or modest outcome by a company that operates and executes more efficiently than maybe their bigger competitors in the space? I just think fundamentally, I think that's just a harder way to make money.
Yeah. Yeah. I think the one thing you can say for them is they've got a huge TAM they're going after. It's a huge market. The hope is you can carve off enough of, you can find that niche that really works, right? It seemed like they had it before. They've lost it, but they can recapture that.
Yeah, I think, the two things I would say they have working in their favor are, one, this is probably the biggest market in like broader enterprise software. I don't think there's a bigger market than broadly. Yeah, in tech. And the second piece is they've built a small multi-billion-dollar business in this market where if you are an acquirer of any kind, financial or strategic, it still could be interesting at the right price. You do have to stop the deceleration, though. Otherwise, no acquirer will really want to touch this asset, I don't think. I think the tricky thing is, like, the cloud market is getting to be a more mature market at this point, and having the informational advantage and the track record in the space, I think, is important. As the space changes, as things become more kind of commoditized, I think like understanding the nuance of this industry is extremely important to getting it right. And you can lead with product, but there are certain constraints on the industry that are going to be there no matter what, right? Amazon is going to have distinct advantage from a capital standpoint. Azure is going to have a distinct advantage from an AI standpoint, at least in the intermediate term. And so I think like understanding how to play your strengths and weaknesses in this market isn't as trivial potentially as just picking up a guy who's really good at product, which I think we would argue the new CEO is maybe doesn't have the track record to support that.
At least he was a product guy. He was not just a suit. I guess I'd argue that. We can debate about the portfolio, but he was definitely a product focused person. He's talking about the innovation roadmap. The part that I'm struggling with is, I would have felt like they would have hit a scaling limit at some point. There's a tremendous network and supermarket effect. And I guess I always say there was a maxim on the sell side, at least in common equipment, in enterprise, where it's like never underestimate just how lazy the kind of like card carrying IT manager is. And like they are just not trying to get on the risk curve or be heroes. Like Amazon, Google, and Microsoft, like those are their three choices. And it doesn't matter if you offer them something that is 1/9 their cost to get it out in terms of egress and all the money they save, and they just don't care. And there's a lack of aligned incentives, right? The IT manager almost never, unless he's reporting to the CFO, like occasionally there's an IT department reporting to the CFO, or maybe half the time, but the average IT manager doesn't really give a crap what it costs. He's just trying not to get fired, make sure that it works. And also it looks way better in his resume than having DigitalOcean certification and experience. Like, great. If you work for a real company, you want to have Amazon on that resume. So all those effects really, I think, stymie the success of what seems like a really compelling product market fit. What I struggle with is how these guys got to 600,000 customers, and they were adding like 100,000 customers a year, and they were growing ARPU, and somehow they just hit a wall. And I don't get it because it's way cheaper, and they seem to have a big community, and like cloud bills are expensive. This seems like it'd be the perfect time to be a hero and start saving money, because those are like IT jobs probably like that you're saving. If you can cut your cloud bill, your egress bill by 80%. So I'm struggling with why they didn't fail earlier and why they can't be 2 or 3 times higher. And I would also put to you that to your point, like you don't need much for this company. Like for $6 billion, like for Oracle to buy these guys and shove it on their channel, they could probably create that. The main reason they probably don't buy it is like there's probably this opportunity cost of figuring out they should buy DigitalOcean, but it's certainly a rare asset. There's not that many private compute companies that are buyable. I still think that certainly it's a large player's game, but man, this has scarcity value. So let me put that out there in your pipe for a moment.
I think it's an interesting company on a kind of a standalone basis. I think one of the biggest problems they have, both in terms of valuation as well as the potential for them to get acquired by a strategic, maybe not so much a financial, is their customer base. Like Oracle's customer base today is largely the big enterprise, right? And we've seen this at other companies who have tried to go to different parts of the kind of customer demographic, and it just doesn't overlap with their sales force. And a lot of these big tech companies, a big part of their kind of overall employee base is just sellers and folks that can take big products to big companies and sell for huge ASPs. This is the type of company that's built like a unique niche type of business in a specific part of the universe that's interesting on a standalone basis, but I don't think it fits well with a lot of the larger clouds out there, even the aspiring clouds. It honestly, it feels like in a lot of ways to me, like you're playing poker and you have one card in the deck left and you're trying to river this card to a victory, but the chances are like one, like
in there.
52 that you even
You know what's going to happen? This new CEO is going to wipe the expectations deck hard and tamp things down. They're going to get a pop in the macro. Like suddenly this thing will re-rate and the whole SaaS complex. All this shit will float to the top. That's the worst crap is just going to go way higher faster, I would think, when the SaaS complex finally recovers. Or they die as Amazon takes all the oxygen out of the room, along with OpenAI and Microsoft and Oracle, I guess now. I guess it's got to call the ball now. The call to make now, is this in a death spiral? Because if it's not, I would argue if it's not in a death spiral, it's probably going to grow better than 11% at some point. You're probably going to have NRR back above 100, unless you just think the AI train has just left and they are just structurally impaired because there's no way they can play in that game. Like it just becomes a commoditized, subscale, SMB compute play that's just going to have a smaller and smaller market. Like, I feel like there's a lot of opportunity for this thing to bounce. And it's not at 7 times, it's not crazy expensive, and they've generated free cash flow. And so it's not, so I don't know. Like, I'm making the she's ugly, but she can cook pitch here. Like, I think that this is going to, it's hard to get burned here. There's a bit of a margin of safety to it. Like, I have trouble seeing this growing at 2% 5 years from now.
Let's move to the short side.
Yeah, I mean, I can jump in quickly. So I think, I think that this market is moving quickly enough where if they're not able to differentiate in some meaningful way, and that probably ends up being cost, then they won't be able to stop the deceleration. Like I think the way that you really can compete against an Amazon or an Azure is really on cost, not so much product and feature and functionality. And the people that are signing up for the $4 a month plan, they're not the customers that you want anyway, really. You want the at least medium-sized customers that are pretty sticky, that have a reasonably sized business, that are going to use multiple kind of products out of your portfolio. And those folks are only going to stick with you if you're simple enough and you're cheap enough. Problem is, like, being cheap enough really impacts your top line. And so I think they're in a really tough position. Like, I think for them to be able to stop deceleration here and falling off the cliff is going to take a heroic effort on the part of the new CEO and really the entire company, both from a product standpoint and from a platform standpoint. So I am not on the fence here, but I will share my reasons why in a couple seconds.
One of the arguments for me that would be more compelling is I do feel like, given who they service is the small developer, right? And so if you think about who was hardest hit in the quasi downturn that we've had, right? It's been the small guys. It hasn't been the large guys. And you can see it in all types of places, whether it's like venture capital funding. Like venture capital funding dried up there for quite a bit, right? How are a lot of these guys getting funded that are doing early development? It's venture capital funding, right? And there's less deals being done there's winners that are getting funded and getting big checks, but like the number of deals is way down, especially at the early stages. And so like that to me is an indicator saying, hey, there's a customer base here that's suffering, that will, as money gets more plentiful and broad spread, like you will see these guys come back with that macro trend. And so that might be an argument for me, but I don't know. What do you think of that, Gordon?
High level, there's a whole other conversation about whether money is going to get easier enough. I think the cost of capital has gone way up, no doubt. Like these guys were born in a free money era. And a lot of these companies, and this is a company that, to their credit, they've earned a lot of generated free cash flow. This return like 140 million into shareholders. Like they aren't the classic like SaaS company that's just burned through money and never had a business model. I don't think that's fair. Like they're an infrastructure company. They have 60% gross margins because they have to pay for their servers. And so I think they've proven a certain level of scale and sustainability that I think that it's hard to put in that bucket of crappy companies. And certainly, yeah, there's not a lot of venture capital formation out there. It was not a good year for venture capital fundraising for sure. And from that perspective, venture money, most of these $4 a month guys, though, those are not certainly institutional VC recipients, right? These are like side hustle dollars, right? These are people working hard for the money. These are like Tootsie dollars, maybe even like an off the beaten path, not quite the level of Tootsie's hustle. But yeah, I think that, I don't know. I don't want, I guess we're going to hold a whole other discussion about, as a country, we're going to keep the printing press going as long as possible and forever. And it's really hard to say when that money train stops, but the level of spending people are just starting to bitch about, massive electoral changes coming, right, depending on who wins. I don't know, it's hard to call the ball there, but I do agree broadly. The macro dead cat balance probably helps them. Like, I think they are lapping a price increase too, by the way. I don't remember how much it was, but that's one thing they're blaming the NDR on too. So they have some pricing power. That's another thing too. Just milk your base and raise prices and sell to private equity. We all go home, right? I think that this is a double. This is like an easy 50 to 100% up. It's definitely not at a near-term peak. This is not Apex Mountain for DigitalOcean. Like, this is, the stock's going to go higher.
Yeah, so I only have a couple things to note here. I think we've covered a lot of it. This, I think, is the rough waters presentation for DigitalOcean. So DigitalOcean, as we talked about, is a dead company walking. Not like the band Dead & Company, but more like a company that nobody wants to buy the equity in. If we scroll ahead to the next kind of drop here, this is a slide for our listeners that shows the NTM, so the next 12-month revenue growth for DigitalOcean at 11% versus a cohort of kind of all SaaS companies. So this is all SaaS companies that are basically public, growing at a median rate of about 13%. So DigitalOcean, a little bit smaller than most SaaS companies, and I've showed, this is actually AWS. It's listed as Amazon, but this is AWS's revenue growth over kind of the last 12 months because I didn't have a forecast for the next 12 months. So it's a good proxy, I think, for how fast Amazon is growing or how fast their AWS platform is growing, which I think is also a good proxy for kind of the broader cloud market if you think about Azure, CP, or even potentially Oracle. I think the thing that I'll note and I'll show in kind of the next click is that Azure may have grown faster, but it's a much smaller base. And so I think, like, when you think about Amazon and the scale they're at, they were obviously the first kind of publicly available cloud, I would say. And so they had a lot of the advantages of being the first mover in this market. And they also have continued to pour money into this segment of their business, and it's continued to perform really well for them, both on the product side as well as just from a standalone operating profile. But the thing to note here is DigitalOcean is growing at 11% versus SaaS companies growing at 13%, AWS growing at 13% as well. DigitalOcean is a fraction of the size of the SaaS cohort. The SaaS cohort is about 4 times as big as DigitalOcean. So DigitalOcean did about $700 million in revenue last year. The average, or the median rather, for the SaaS cohort was $2.2 billion. And Amazon's business is a $100 billion run rate business today. So to put that in perspective, Amazon is doing as much revenue as DigitalOcean every 2 days of the year. And they're still growing 2% faster. If that doesn't tell you that a company is dead, then I don't know what does. So that's point number one, I'd say. This is a company that is a niche business. It's in a very big market, but they have a very specific offering, and they're getting waxed by their biggest competitors. And they're even getting waxed by kind of the broader SaaS universe. I think if you go to the next slide, the other big, I think, component of how people are thinking about DigitalOcean is just trying to figure out what's going on with their net dollar retention. So net dollar retention, as we may have mentioned before, is a metric that demonstrates how many dollars effectively a company is going to walk into the following year with, in terms of if they didn't sell an incremental contract or an incremental customer, how much they would grow. And so for most SaaS companies, that metric is around 110%. So if most SaaS companies in this cohort were to stop selling completely, their business would still grow 10%. And that's a little bit different than gross dollar retention, which is the gross amount of dollars that a company will retain over a 1-year period. if you add in net, so that takes into account the level of people that are attriting from the service and the level of people that are churning from a service and the level of people that are downgrading from a service. You add that back to the folks that are expanding the service, the folks that are buying incremental services that are part of your customer base, and that's how you get to your kind of net dollar retention number. And for most SaaS companies as a cohort, that's about 110%. World-class kind of elite net dollar retention is 115%. DigitalOcean's net dollar retention, so this is after all the churn and all the upgrades, is 97%. They walk into every year with a 3% hole. They're only going to get back to their original number after they've made 3% back. So they start in the red every single year, whereas most SaaS companies start in the black. And so this is a company that is probably one of the worst NDR metrics.
Let's just be real though. The number was 96 the last 2 quarters, and it was like 116 a year ago. So I feel like you can't. This is not fact, right? This is a consensus number that almost nobody forecasts. Like almost nobody forecasts NRR. I can tell you as a person that's forecast NRR internally, it's fucking hard. Huge stochastic component. So I don't know. I just don't take this as fact. I'm going to argue that you're taking 2 quarters and a bullshit forecast. There's literally, this company's been in existence for how many quarters? And we have how many quarters of numbers? It's been below 100 for 2. And this forecast is horseshit. I'll take the over on that. I'll tell you what, I'll bet a helicopter ride with that bunny rabbit that it will be more than 97 over the next year. It'll be over 100 in the next year. Anyway.
It also goes to the usage-based model, right?
It does in some ways, but consumption-based models have worked really well for a lot of companies. Look at MongoDB. Look at Snowflake, for example. This is a company that has a consumption-based model that's failed in the market, despite the fact that the cloud market is growing, that it's expanding, that even their own customers are probably expanding their cloud footprint. But instead of using an expanding cloud footprint with DigitalOcean, they're probably going to a competitor, which is why their net dollar retention is so poor. And just to be clear, this is the net dollar retention that's being predicted for the company over the next 12 months. So this is what companies are looking at, or this is what analysts are looking at for 2024. This is not a retrospective. This is a projection on what the company will do for the next 24.
It's funny because they've guided to 100 in the second half. So like, basically these analysts have just, it's bullshit numbers, probably like 2 estimates in there, but all right, fine. So I think what really happened here was they talk about the pricing anniversary from June of last year being a big driver of their NRR being down or NDR being down. I wonder what the real story here. They won't say this exactly this way, but basically they raised prices. The ones that are stuck there stayed, and they're still now facing like a bit of an exodus, something that turned them negative. They claim their churn, by the way, is basically the same and has been constant-ish around like 11, 12%. That's a huge amount, right?
I think it speaks to the larger point, which is this is a company that has to do a lot better on execution, both on the sales side and on the product side, just to retain their customers. And they're effectively, like, I think Gordon said it best, this is catching a falling knife. This is a sinking boat. In order to get comfortable with taking an equity position in this stock, you have to bet that they're going to be able to plug the holes on this boat, that they're going to be able to turn this ship around. And I think that's a very risky bet to make in this market where you have very well capitalized competitors, you have a lot of commodity services, and you have a lot of companies that are willing to shift from cloud to cloud based on pricing, not on anything else. I think for most software companies, I'm not speaking about all software companies, but as a class, I would say that most software companies can get comfortable with 5 to 10% churn. So looking at 90 to 95% gross dollar retention. I think the problem is for a company like DigitalOcean, they are not expanding their current customer base as rapidly as other software companies in their cohort or other software companies where you could put that incremental dollar to invest, incremental dollar at work. And so most software companies then are growing their customer base, right, by call it 15 to 20%. And so their net dollar retention, even if their gross dollar retention is 90 to 95, is still 105 to 110. Whereas with DigitalOcean, it's 97. And that's a problem, I think, that analysts are most focused on, because a net dollar retention number under 100 is a very troublesome sign for any company, putting DigitalOcean aside even. And so I think the sooner they're able to rectify that and prove to the street and investors yourself included, Gordon, the more comfortable. So just to go to the next slide is just valuations. There's a really easy, simple, but wrong answer here that I think Gordon has spent a lot of time on. And then there's a more complex but right answer here, which I will now jump into. The reality is that DigitalOcean is actually priced underneath a lot of their peers in terms of the EV to next 12 months free cash flow multiple. So the slide that we're showing right now for our listening audience is a slide of all of the software companies as a cohort that are above 0 in EV to NTM free cash flow and under 100. So all of the companies that are effectively relevant. And as a group, those companies trade at about 33 times next 12 months free cash flow to EV. The long-term average is about 40 times. So as a group, these companies are trading a little bit under where they have historically. I think that DigitalOcean today trades at around 25 to 30 times EV to next 12 months free cash flow. So it's trading underneath its peers. And the reason for that is that it's a much worse company than most of its peers. Its net dollar retention is a big factor. Its customer base, being small and medium-sized business, is a big factor. Its growth in the market, I think, is a very big factor. I think for all of these reasons, I think the market is giving DigitalOcean a discount to its peers. And that's something that I think will persist unless they're able to turn around the narrative on any of these key points. I think there's a lot of risk, though. You're making a big transition at the management level. The market continues to change pretty dramatically. I think they're undercapitalized relative to their peers. I don't think their customer base is going to change very meaningfully because I think enterprise customers are still going to want to work with the largest clouds. And so I think packaging that all up together, I think it's a very risky long. I don't think there's a lot of near-term upside here, even if they execute flawlessly, which I think has a lot of risk just inherent to it. With any management change at the CEO level, I think you're inherently adding risk to the equation. But even if they were to execute flawlessly here, I think it's still a very tough narrative to get super strongly convicted around, just given all of kind of the corroborating factors around the market, the company, the dynamic in this space.
Maybe one thing you skipped over quickly is why free cash flow is the right multiple.
I was going to say, so I think that free cash flow is the right metric for a couple of reasons. One, I think that's how the street is valuing the company. I think this is a free cash flow business. This business is growing so slowly that it no longer really can trade on revenue. They're building the company to generate free cash flow for their investors. I think that this is a company over the long term won't inflect or reinflect from a growth standpoint. And so I think that whereas a lot of SaaS companies today trade on ARR or revenue, this is a company that will trade on free cash flow.
All right, so let's talk about that for a second. What is 33 times? I mean, it's just funny to watch a West Coast investor like fumble around with free cash flow. Like 33, you know what that is? It's like a 3% free cash flow yield. 40 is like 2.5%. So if you want to call that a difference on a market cap that moves more than 1% a day, like I think it's just bullshit. You're taking the inverse of a percent. I'm going to give you partial credit, but I'm going to say like they generate free cash flow more than others and been more focused on it. And certainly they should be growing, no doubt, faster than they are right now. It's embarrassing. They showed up to a gunfight with a knife in terms of their growth rate comparing to other SaaS companies. But I would kind of argue that if they're trading at 7 times and growing 11% and positive free cash flow, like that doesn't sound insane. If other companies are growing double that and getting 14 times sales, like I think it's still trading on a revenue multiple, honestly, to some extent. And they've checked the box on that they can generate cash flow and they don't have that going out of business, flirting with profitability or free cash flow generation multiple at 7 times sales. I think they're just in the goodie room, but they're in the lowest goodie room at 7 times sales. So I think they're still trading on revenue. I'll hand it back, but I think we're fooling ourselves and playing with numbers on these free cash flow multiples at these low percentage yields.
You just have a business that's also a heavy CapEx spender. And so a lot of those other multiples don't take that into effect. Therefore, free cash flow is actually a multiple where you are looking at CapEx expenditure, because if they're growing their data centers, they're investing, that impacts free cash flow, right? And so from that standpoint, like if you look at EV to revs, that's completely lost if you're throwing it all down the tank and continuing to have to invest in your business. So I do think it's a relevant metric. But Bruce, I want to give you a chance to wrap up here. I I have a good summary of your argument, but I'll let you do it if you have one.
The only thing that I just add, though, is I think we can all agree that this company trades below most of the SaaS cohort across every metric, like whether it's free cash flow or revenue multiple or even EPS. This is a company that trades underneath all of their peers, but there's a reason that they trade. It's a cheap stock for a reason. The reason is it's a bad company in a tough space. And so I think that's the thing I think investors need to grapple with. And so that's why I think, like, on balance, like when I think about this company, just in terms of wrapping up from my perspective, my real view on the company is I think they're in a very tough space. I think it's a really highly commoditized market. It doesn't feel like they have the team to do it. It doesn't feel like they have the product to do it. And I don't like the customer base very much. I think a strategic outcome here is going to be challenging, just given that customer base. And I would stay on the sidelines here, just from a personal standpoint.
All right. So your real view matches the position you took. Gordon, how about over to you? You're obviously holding the stock. There's probably some emotional tie to it. Are you still a believer, or have you been convinced to let go?
Honestly, I feel worse about it. Digging into it after I bought it, I definitely feel worse about it. But I would also argue, I don't see, this is not comm equipment or some of these horrible airlines, like where companies get to a certain, almost get out of the nest and then just implode. That's not happening here. This is not like the Tell Labs of software. Like, I feel like it's a more persistent business. There's not that many companies you can find that get to this level of sales, almost $1 billion in sales, and then just wither and die and like decline and like asymptote to 2% growth, especially in the middle of a pretty soft economic patch. So I'm going to argue that this stock is not as risky as it looks. If it were a hardware stock, I think it would be very risky. I do think that the SMB element is probably showing as much as anything else right now. Like, it's a very not a fun time to be exposed to the SMB. It's also not a fun time to be a subscale player in an AI arms race where everybody's got to check the box on AI. So I definitely don't feel better about it. I feel like this is probably one that won't get away from us for a year. But I bet you in 2 years, it's 50 to 100% higher. But I'm not as excited about having rushed out and bought it so recently. So yeah, I'm a long-term believer of this. I would still buy it. I just think it's dead money for a year, probably. I don't think it's going lower. I just don't think it's going to be range bound for a year. But 2 years from now, you can probably harvest this to go short more super micro if you want.
My quick view, listening to the arguments, I was intrigued by this name and talking about it because I could see where if there were signs that could convince me a turnaround was coming, I would be very excited to take a flyer on this one, given the huge market it plays in. But I haven't heard anything that I would say is a catalyst that I want to invest behind. And I don't think the new management team is one of those. And I think all the cloud growth has been coming down across the board. And so I think they're getting hit the hardest at the low end of the market. I'm not sure when that turns around. And so for my money, I think there's better things to do with it in the short term. So I tend to line up with Bruce on this one, and I'll be on the sidelines. All right. With that, we will wrap it up. Thanks, gentlemen. Next time, maybe we'll do a little bit of a larger cap name. And one of these days, we'll start soliciting maybe suggestions from our audience of 5 to see what they want to hear on what names. But for now, as we've been wrapping, bulls make money, bears make money, and pigs get slaughtered. See you guys next time.
Say make money, money, make money, money, money.
Make money, money, make money, money, money.